Regulators seized troubled First Republic Bank early Monday, making it the second-largest bank failure in U.S. history. This development raises questions about the health of the U.S. banking system. Promptly, all of its deposits and most of its assets were sold to JPMorgan Chase in a fire sale. It's the third mid-size bank to fail in less than 2 months. The only larger bank failure in U.S. history was Washington Mutual, which collapsed at the height of the 2008 financial crisis and was also taken over by JP Morgan in a similar government-orchestrated deal. The bank's seizure. Why did it happen? First Republic Bank, a San Francisco-based lender, struggled with mounting bad loans, and the decline of the Bay Area's commercial real estate market. Its loan portfolio heavily relied on the property markets, particularly in San Francisco, New York City, and other parts of the West Coast. As a result, the bank experienced significant losses and eroded capital as borrowers struggled to pay their debts amid the pandemic's economic downturn. The Office of the Comptroller of the Currency and the Federal Deposit Insurance Corp. (FDIC) announced the bank's seizure on Monday, citing the bank's inability to maintain adequate capital and liquidity levels. The seizure is seen as a measure to prevent a possible systemic risk and to protect the bank's customers. The bank's sale. What does it mean? In a bid to end the turmoil, the FDIC sold all of First Republic Bank's deposits and most of its assets to JPMorgan Chase. This move comes after JPMorgan Chase was recently named the most valuable bank in the world. The bank's shareholders are likely to be wiped out as part of the deal. "Our government invited us and others to step up, and we did," said Jamie Dimon, chairman and CEO of JPMorgan Chase. First Republic's 84 branches opened on Monday as branches of JPMorgan Chase, which acquired the bank's $92 billion in deposits and $203 billion in loans and other securities. The acquisition of First Republic Bank is expected to increase JPMorgan Chase's presence in the San Francisco Bay Area and expand its commercial banking operations. The deal will also add to JPMorgan's earnings and balance sheet, while providing a boost to its market share in the banking industry. What happens next? The seizure and sale of First Republic Bank have raised concerns about the health of the U.S. banking system. The recent bank failures are seen as a reflection of the pandemic's economic impact, particularly on the commercial real estate market. The prolonged economic downturn has resulted in increased credit losses, eroded capital levels, and liquidity challenges for many banks. The FDIC's move to sell First Republic Bank's deposits and assets to JPMorgan Chase is seen as a proactive measure to prevent the bank's collapse and a possible systemic risk. The acquisition of First Republic Bank by JPMorgan Chase is expected to strengthen the bank's position in the banking industry and expand its commercial banking operations. However, the acquisition also raises concerns about the consolidation of the banking industry and the concentration of market power in a few large banks. Some experts warn that the acquisition could result in higher fees and less competition in the banking industry, potentially hurting consumers. Possible impacts of the bank failure. The bank failure and seizure of First Republic Bank could have far-reaching impacts on the U.S. banking system and the economy. Some of the possible impacts include: 1. Loss of investor confidence. The bank failure could erode investor confidence in the U.S. banking system, particularly among mid-sized banks. 1. This could result in higher borrowing costs and less credit availability for consumers and businesses. 2. Regulatory scrutiny. The bank failure could lead to increased regulatory scrutiny of mid-sized banks' lending practices and risk management. 2. Regulators could introduce new rules and guidelines to prevent similar bank failures in the future. 3. Increased consolidation. The acquisition of First Republic Bank by JPMorgan Chase is part of a trend of increasing consolidation in the banking industry. 3. This trend could result in fewer players in the market, potentially leading to higher fees and less competition for consumers. 4. Economic impact. The bank failure could have a negative impact on the local economy, particularly in the Bay Area, where First Republic Bank had a significant presence. 4. The seizure of the bank's assets could result in job losses and reduced credit availability for local businesses. Lessons learned from the bank failure. The bank failure and seizure of First Republic Bank provide important lessons for banks, regulators, and policymakers. Some of these lessons include: 1. Need for diversification. Banks should diversify their loan portfolios and reduce their reliance on specific sectors or markets. 1. Diversification can help mitigate risk and reduce the impact of economic downturns on banks' financial health. 2. Importance of risk management. Banks should have robust risk management systems and processes in place to identify and manage potential risks. 2. Effective risk management can help banks avoid or mitigate losses and maintain adequate capital and liquidity levels. 3. Need for regulatory oversight. Regulators should closely monitor banks' lending practices and risk management systems to prevent excessive risk-taking and ensure banks' financial health. 4. Importance of deposit insurance. Deposit insurance, provided by the FDIC, is a critical safety net for depositors and can help prevent bank runs and financial crises. Conclusion. The seizure and sale of First Republic Bank to JPMorgan Chase is a significant event in the U.S. banking industry. The bank failure highlights the challenges facing mid-sized banks in the current economic environment and underscores the importance of diversification, risk management, and regulatory oversight. The acquisition of First Republic Bank by JPMorgan Chase is expected to strengthen the bank's position in the market and expand its commercial banking operations. However, the acquisition also raises concerns about the consolidation of the banking industry and the potential impacts on consumers. Moving forward, banks, regulators, and policymakers should learn from the bank failure and take steps to prevent similar events in the future. This includes diversifying loan portfolios, implementing effective risk management systems, and ensuring adequate regulatory oversight. By doing so, the U.S. banking system can remain resilient and continue to support the economy.